Hi everybody, welcome to the webinar. Come on in, make yourself comfortable. Mary and I will kick off our conversation in about a minute. Come on in, make yourself comfortable. We'll get started in about 30 seconds. All right, well, thank you everyone for joining us. Welcome to our webinar today. My name is Jeff Thurrock. I'm a director of Australian Advice Network and Evalesco, and I'll be your host for today. With so much going on in the world, we have a lot to discuss around the topic of rising geopolitical risks and portfolio implications. We couldn't have a better qualified person to lead us through that discussion than today's guest, Mary Manning, Global Portfolio Manager from Alphinity. So welcome, Mary, and thank you very much for your time.
Thank you, Jeff. It's great to be here.
So I'm going to tell you a little bit more about Mary in a moment, and then we'll get into the conversation. But just before I do that, I just want to let everybody know at home that during today's webinar, you're on mute and your video is turned off, so we can't see or hear you, but we do encourage you to ask questions by using the Q&A button down the bottom of your screen. So if you click on that and type in any questions you may have, we will look to cover those off throughout the session or at the end of it, depending on how much time we've got. Most of our conversation today will be about general financial markets and insights. So I just wanted to give you this general advice disclaimer. And even though most people on this call are clients of AAN or Evalesco, we aren't considering your personal circumstances as we go through today's conversation. So if you do have any questions or would like to know more about how it may relate to you, please do reach out to your advisor or me at the end of this session. You can see on the screen here our agenda for today, and you would have seen that in the invitation as well. We've got a fair bit of ground to cover. As I said, there's a lot going on in global markets and particularly geopolitical and reporting season recaps. So quick introduction to Mary. You can see on the screen that Mary has a wealth of experience in investment markets globally, having worked across New York, Moscow and London and now Sydney for many years. Mary is an expert in the areas of technology and communication service sectors and global equities, broadly speaking. So very well placed to take us through the next 45 minutes or so of conversation. So to kick it off, Mary, we've recently completed the reporting season. What are some of the key themes that played out during that recent reporting season?
It was a very interesting reporting season. I guess since the bottom of COVID in March 2020, we've been in a very strong beat and raise cycle for global equities. And, there was just a lot of earnings momentum. And I think in this quarter and maybe a little bit the quarter before, we've started to see that momentum wane. So, Alphinity is our whole process is based on looking for stocks that have earnings leadership and that have that earnings momentum. And in a lot of the quantitative analysis that we do, it shows that earnings momentum and the earnings cycle is starting to turn over, if not, has already turned over. So if you look at earnings overall, there still was, a few slight beats. I think it was around 1%, ahead of consensus, but that was very weighted to a few large cap tech companies and also to energy. If you strip out, sort of Amazon, Google, Microsoft, and the energy companies, it by and large, it was a miss by a lot of companies. So you can see there on the slide on your screen, that green line that's showing that the earnings revision ratio is clearly on the way down. It's still above the zero axis, but it's clearly down from where it was in 2020 and the beginning of 2021. Another point I'll make about the earnings cycle is that the incidence of companies providing guidance went down, certainly. And one thing we noticed is that the sooner in the calendar that companies reported, the more likely they were to give guidance. Some of the European companies that have just reported in the last 2 weeks, they are very reticent to give guidance because obviously the situation in Russia and the Ukraine has just clouded visibility. So the combination of that beat and raise cycle looking like it's turned over and companies not having a lot of visibility to be able to give investors guidance it was a rather muted earnings season.
So what are some of the reasons that they not giving guidance? I mean, you mentioned the European issues, because I guess is that because it's hard for them to know what's happening? There's a little bit of uncertainty in their own sort of world, or what are some of the other reasons that might be the case?
I think it depends on what sector they're in and certainly what geography they're in. So for a lot of companies, it's not that they have direct exposure to Russia and Ukraine. And there's a slide later on that highlights that, across the globe, most multinational companies, their exposure to Ukraine and Russia is very small, like 1% to 2%. It's more the second and third order effects of what's going on in the world, including the Russia-Ukraine situation. So, supply chains have been an issue for, since COVID started, really. And it's just sort of this rolling thing that, at first it was COVID shutdowns in the US, and then it was shipping issues, and now it's Russia-Ukraine. So I think particularly for industrial companies and some of the consumer discretionary companies like autos that do have quite sophisticated and extensive supply chains, they just have very limited visibility. And so they're reticent to give guidance, and that's fair enough. To give you some sort of anecdotal evidence, I had a call with Mercedes-Benz, and they said this is a day-to-day situation for us. So we're not going to give you guidance for 2022 or 2023 when this is a day-to-day thing. Other European auto companies have mentioned similar things. They're taking this week to week. So there's just not a lot of visibility there. I think the second thing, more for US-centric companies, would be that the labor market is still uncertain. So a lot of companies in the fourth quarter of last year, wages went up a lot. And that was both because the US labor market is hot and also because you had the Omicron wave hit. And so not dissimilar to what you saw in Australia, people were paying overtime and overtime plus to get workers just because there were so many people that couldn't attend work. And so the rate of normalization in the US labor market post Omicron, and then that is also something where there's not a lot of visibility. And then lastly, just in terms of interest rates for anything that's interest rate sensitive, we all know that interest rates in the US are going up, but if you're a financial, for example, that has an asset sensitive balance sheet, you're not sure whether rates are going to be 200 basis points higher or 75 basis points higher by the end of the year. So the combination of those 3 or 4 things means that sort of across sectors, companies are relatively reticent to give very strong specific guidance.
Okay, thanks for clarifying that. On your next slide, you've got a few examples.
Yeah, so this highlights what I was saying before in terms of, obviously energy are those strong blue bars that show over both a 3-month and a 1-month earnings revision ratio. Energy and materials and those more cyclical parts of the market are driving that. So we're actually not positioned very strongly in earnings and materials, because we look at earnings upgrade cycle taking a long-term view. And a lot of those revisions that you're seeing on this slide are just mark to market of commodity prices and the oil price. And that, that's helpful from an earnings revision perspective. But, if there's a ceasefire tomorrow and oil went back down to $80 or somewhere significantly lower than it is now, those blue bars on energy would not be like that. So we're looking more for stocks that have, they're in earnings upgrade cycle and are not just getting upgrades because of mark to market.
Okay.
If we go about technology, this is something which is very interesting. And, this really is a stock pickers market now, probably more so than it's been in many years past, and certainly since the COVID bottom in 2020. Because, the FANG stocks got their name because they all kind of traded together for quite a while. And this was the first quarter where you saw a massive divergence between the fate of the FANG stocks. So obviously Facebook and Netflix, as you can see here, they both missed earnings, and Netflix in particular because of their forecast on users, and then Facebook, there was a lot of things going on in that result, but they both fell 20 to 25%, and interestingly they kept falling after that. And then you had companies like Apple, Amazon, and Google, and Microsoft is obviously not a FANG, but if you use FANG Man or one of those other acronyms, it would be in there. Those companies did very, very well. So, we have a large exposure to the big technology stocks in our portfolio, and being able to pick between the winners and losers within that subsector of tech is very important, and very important for alpha generation going forward.
Yeah, that's a really interesting slide, isn't it? Because as you said, we looked at the FANG as being one movement and watching how they all act together, but now they're starting to diverge, which makes it trickier for the man and lady on the street.
Yeah. And it's a good segue into the next slide, which is, I believe, about COVID, because one thing that we noticed in the last quarter of earnings is that companies that have users generally did quite badly. I think Disney is the only one off the top of my head that sort of bucked that trend. But it doesn't matter if you're Spotify or Netflix or Facebook or Twitter, these stocks that are users based and they trade on the number of users and the number of net adds of users, they generally did very badly. And our analysis shows that part of the reason is that a lot of that demand and a lot of that user growth got pulled forward in COVID, and now it's giving that back. And that for stocks that started trading on the growth in users, now that's negative or at flat at best. And that is having a significant negative impact on their stock prices. So this chart is focusing on the COVID implications for global equities. And you can see that a couple of things have sort of derailed the post-COVID rally for global equities. One is, as I said, there's this pull forward, and that game seems to have, not a game, but that thematic seems to have stopped. So there's a number of stocks out there that we call round trippers, because they're stocks that were COVID beneficiaries and they went way up, like some of them, tripled, quadrupled during COVID. And interestingly, they've given that all back. So it's not just that they went up and then they gave some back. They literally, like the stock price implies that COVID didn't happen at all. And while it was incorrect market interpretation for them to go up so much, it's probably also an incorrect interpretation for them to go back down. So think about Zoom, for example. Before COVID, nobody used Zoom. I certainly didn't. And now it's post-COVID and we are on a Zoom call, and I do 5 or 6 Zoom calls a day still, especially during global equities when travel is still a little bit limited. So does it make sense that Zoom has gone all the way up and all the way back down when there's hundreds of millions of people around the world that use Zoom now and they didn't before? Probably not. So I'm not saying that we're not rushing to buy any of the stocks, certainly, that are listed there. But it is quite interesting how a lot of those COVID gains have given back 100%, in some cases more than 100% of their gains. I think the second thing to highlight about the post-COVID rally is that inflation is a very big concern, and I'm sure you're spending a lot of your days thinking about inflation and the implications both in Australia and for global equities. But that means that the sort of stocks that have the market leadership has certainly changed, and that's a big part of Alphinity's process, which is following or investing in stocks that have that earnings leadership. And the types of stocks that have that earnings leadership are not always the same. So certainly, for the last 2 years, you've seen a lot of the growth stocks have done very, very well. And now you've seen a rotation into more value-oriented and certainly into financials and some of the stocks that do better in a rising interest rate environment.
Mm-hmm. And I guess there's been a bit more talk in recent times around COVID and China and what's happening in China and how that might impact globally. What do you see as some of the implications of how they're going at the moment?
So as you know, I spent a lot of my career, 15 plus years working in emerging markets. So I have spent a lot of time looking at China. And I can't remember a time in the last 20 years, not even sort of Asian crisis or GFC, when there's as many things going on in China as there are now. So you have a major macro slowdown, which is partially related to COVID, but partially just a macro slowdown. You have the whole Evergrande situation and the implications in terms of the property markets and the flow-through effect of property market to other asset classes. You have a whole regulatory crackdown in terms of, for any of you that follow the Chinese tech companies closely, I mean, they've been absolutely slaughtered in the last 18 months. So you have a whole sort of a regulatory reset around technology and other industries. And then you have sort of a political/geopolitical overlay in terms of what's going on with Hong Kong and, a lot of noise around Taiwan. So China is extremely complex right now. And when you layer on top of that, the fact that China is one of the only major economies in the world that has stuck with COVID zero. I mean, even New Zealand has given up on COVID zero now, and China with 1.3 billion people is still trying to use COVID zero as the policy. The implication for equities is, what does the path out of COVID zero look like? And frankly speaking, I thought that after the Olympics that China would sort of start to muddle its way out of COVID zero. But that actually didn't happen. You saw even last week and the week before, China putting huge cities like Shenzhen, which is almost 18 million people. And it's like the San Francisco of China in terms of the predominance and the importance to the tech industry. All of Shenzhen went into lockdown for a week. And so that's sort of sending the message that, no, we are not committed to getting out of COVID zero. It's sending the message that we're still prioritizing health outcomes over, potentially macro outcomes. So the big question for many investors is what does China do from here? I think the fact that the Shenzhen and other cities lockdown was only a week is a positive thing. This wasn't okay, you're locked down until, indefinitely. And it looks like a lot of the factories, were only shut down for 2 or 3 days. So that's a positive from a supply chain perspective. I think another thing that I'm looking for is most people in Chinese have the Sinovac vaccine, and Sinovac, there's some debate as to whether the official statistics about its efficacy are believable or not. So I think you're going to need a vaccine rollout and certainly booster shots with Sinovac or something that's more effective. But China, I mean, at some point this year, it should start to move away from COVID zero, but it's certainly not happening as fast as anyone thinks. So we are watching that from a global perspective. It's important because a lot of multinational companies have big exposure to China. So, Nike, Apple, LVMH, the whole luxury space, they're very exposed to China macro. So we need to watch that in terms of the demand side. And then on the flip side, as China does start to reopen, that's going to be a huge tailwind for these companies because they've been under pressure for almost 2 years now. So, there's going to be some inflection points later in the year. We are not really seeing it right now, but I think it probably will come before the end of 2022.
Okay. Interesting to continue to watch it there. Looking more globally, are there any obvious sectors or companies you think are well positioned or best positioned to really benefit as we move into a hopefully soon post-COVID world?
So for a while they were like COVID winner plays and COVID loser plays, and then there was the reopening plays and the reopening winners and reopening losers. And I think that's a bit of a dangerous way to classify different stocks because, I mean, the Alphinity way is to always have high quality stocks in a very diversified portfolio. So we would never bet the farm, so to speak, on reopening plays because that's very risky. And if you're wrong, then obviously performance takes a big hit. So we don't have very many reopening plays per se, but I think there are parts of the consumer market that will benefit from reopening. I mentioned LVMH before. All these European luxury stocks, people often travel to Paris or to sort of luxury destinations, and that's where they do their shopping, and that's beneficial. So LVMH is one that I would call out that would be a beneficiary there. We are doing some work on some of the hotel stocks. So Hyatt and Hilton are two examples. These are stocks where occupancy is still way, way below where it was prior to COVID. And also, just travel in general, it's too early, but it looks like they could be in an earnings upgrade cycle going forward. I guess the flip side of your question is where are some stocks where there's risk? Mm-hmm. I guess one would be, the low-end US consumer. Because of COVID, a lot of these sort of consumers got the stimulus checks and they went out and spent that, I don't know, at Dollar General or at Target or something like that. And so we're very conscious of the fact that when those stimulus checks have been removed, that low-end consumer, even though the labor market is very strong, inflation is very high and it's higher than wage growth. So they have the removal of the stimulus check and the squeeze from inflation, and that part of the consumer discretionary market is a bit under pressure. So those are two areas that I'd call out.
Okay, right. I guess looking more at risks and opportunities across asset classes, your specialization is in global equities. So what do you see as some of the other key risks, whether they're geopolitical or the macro situation that we're facing? I know this slide's got a few sort of pointers to what some of them might be, but what are you seeing in that space?
Yeah, so inflation, it's not new news, right? At this point, I think everybody knows that inflation is a risk. So the main issue or the main area of analysis is what type of inflation and what level of rises in Fed funds are priced into the market now. And Alphinity, we're not macro forecasters and we're not orienting the portfolio around a certain macro outcome. So as I mentioned before, diversification is very, very important in this sort of environment. And that's diversification, across sectors and also across subsectors. So in financials, for example, we do have banks like Bank of America and Wells Fargo that are beneficiaries of higher rates. So that's a positive. We also have, stocks in the portfolio that are more market oriented and are not rate plays. Insurance is another subsector within financials that are beneficiaries of higher rates. So I think at this point, our approach is not to bet the farm on a certain macro outcome, because similar to betting the farm on a COVID outcome, that's very risky, but to make sure you have diversification across different outcomes, both at a sector and a subsector level. I think the big question out there for markets is whether this sort of environment is similar to the 1970s, where you had stagflation, you had an oil shock. And that is a big question out there. I guess the answer depends on how long the conflict between Russia and Ukraine remains. But certainly if oil stays, at 110, 120 for a certain amount of time, or certainly if it goes significantly higher than that, and you get to see evidence that the Fed is behind the curve. So this is obviously the big debate is how far behind the curve is the Fed? Should they have started raising in August? And how much of this inflation is transitory? If you see a very aggressive Fed and oil prices staying as high as they are, then I think stagflation is a real risk for markets. And in that sort of environment, we probably add to our more defensive stocks in the portfolio in that sort of outcome.
So can you just fill us in? What does stagflation mean, and how would that impact different sectors or different companies?
Yeah, so stagflation is when you're getting inflation, but you're also not getting any growth. So there's sort of a disconnect between, usually you would be raising rates because growth is so strong. But in this sort of situation, then the Fed would be raising rates at the same time where growth is significantly falling off. And I'll give you a funny story. Once when I lived in New York, I by accident was invited to this dinner with Alan Greenspan. At the risk of sounding like a total nerd, it was like the coolest night of my life. But anyways, he made a really good point, and I'll always remember it, because he said, the thing is that inflation, we know how to deal with it. But deflation, we don't know how to deal with it. And so I think that what you've seen over the last few years is so many central banks around the world have gone to the zero band, and they've gone into QE, and they were very worried about that deflationary sort of environment. And because of COVID and all the stimulus that went with it, now you have inflation running at like decades high in the US, and central bankers are like, hang on a second, we know how to deal with this. We just raise rates and raise rates and raise rates. But the big question out there is, if you're raising rates to deal with inflation and you're behind the curve, you're late doing this, so growth is already starting to taper off, then you can really do quite a bit of damage to the economy. So I think that's the risk in this sort of environment. So in terms of how to position, again, I've said it so many times, you're probably going to be sick of this word, but diversification is very important. You don't want to be in all high growth stocks, and you don't want to be in you don't want to just have an undiversified portfolio. So we right now in the last 6 months, have added to some defensives, because stagflation is not a happy macro place. So to be in defensives is a good idea. So we've added stocks like McDonald's and Pepsi and some utilities, which are a relatively good place to be in that sort of environment. And we've also been quite disciplined about taking profits in stocks that have done extremely well and where valuations are stretched. So this was more at the end of last year, but stocks like Nvidia and Blackstone, I mean, some of these had doubled, if not more, from the COVID bottom. And the PE multiples were looking very stretched. So we've just been very disciplined in bringing those down, which leaves us in a good position for whatever macro situation comes to be.
Great. So I guess moving on to the other big issue facing markets, macro wise, just looking at the economic side of it, not anything else, but Russia and Ukraine and how that impacts different sectors. Can you talk us through this slide and some of the things that you're looking at there?
Yeah. So the first thing I'll say on this slide is actually from a personal perspective. So when I was very young, this is 1998, I was working for Salomon Brothers at the time, and I moved to Moscow, or they moved me to Moscow to work as an investment banker in Russia. And this was, right at the opening up of Russia, and this was perestroika and glasnost, and all these consumer companies wanted to get into Russia, and the bankers wanted to IPO all the companies that were already there, and it was a very, very exciting time. And, the sad thing for me from a personal perspective is that when the conflict started, we called all of our companies across the portfolio and said, what's your exposure to Russia? And the overwhelming answer is basically nothing. So I think, across our consumer companies, it's less than 2%. The general answer is 1 to 2%. And across, technology or other sorts of companies, it's literally zero. And so that, it's quite sad in terms of there's so much potential for Russia. And remember, there was the whole push about the BRIC companies and BRIC countries, so the emerging markets, 4 horsemen of Brazil, Russia, India, and China. And Russia has really underperformed the other 3 and it is not necessarily integrated into the global economy the way a lot of people thought.
Yeah.
So that's a preamble to this slide saying that there is some exposure directly. There's some second and third order exposures, but overall it is not huge. So, if markets sell off very significantly just because of the Russia-Ukraine situation, there will probably be some valuation, probably be some opportunities there because the direct earnings impact is quite small. But just to give you an idea across sectors, so consumer, some of the stocks that we have, McDonald's, LVMH, Estee Lauder, and Pepsi, are actually the first 3, have very small exposure. Pepsi has about 3%, which is probably the highest in our portfolio. And McDonald's, LVMH, and Estee Lauder have actually suspended activities in Russia. So we can get to ESG later on, but this is one of the first times where we've seen very, very specific business decisions because of a conflict, and the decisions have been made on ESG grounds. I personally think it's a bit risky because it's easy to pull out of Russia if it's 1% of your sales. But what if something happened in China where it's 30% of your sales? It might be a different opinion.
Yeah.
Anyways, so the the direct exposure is quite limited there. The interesting thing is McDonald's certainly is continuing to pay its employees there. And so one of the things that we're watching from an earnings perspective is, if the conflict lasts for a year or 2 years or something, are these multinationals going to continue to pay their employees there? Because that turns into an earnings drag. You have no revenues and you obviously still have costs. In terms of autos are probably the most impacted in our portfolio, not because they have direct exposure to Russia, but because a lot of the auto supply chain in Europe is in Central and Eastern Europe, and not necessarily in the Ukraine, but obviously nearby, and there's a lot of supply chain issues there. So we have trimmed our position in Mercedes-Benz, and as I mentioned before, they have very little visibility. The stock is trading at an extremely low PE, so certainly some of that lack of visibility and potential earnings downgrade is priced into the stock. But autos is sort of one place to watch. Technology, very little impact. I guess one thing to highlight is that this is a different kind of conflict than we saw in the past, and certainly in Cold War times. And a lot of the cybersecurity and the use of social media, some of the stocks that we don't own, like Facebook and Twitter, have gotten kicked out of Russia. Some of the Ukrainian use of social media to pressure multinationals. It's sort of a use of technology that we haven't seen before. We do have a large position in Google, which bought a company called Mandiant, which is a cybersecurity company that happened right after the invasion. So that cybersecurity is a sort of part of the technology subsector that we're doing a lot of work on right now. Mm-hmm. And then lastly, energy and renewables. This is the most obvious given what's happened with the oil price. We didn't have any exposure to the major multinational energy companies that had assets in Russia, so that's a positive. The main thing the main area of analysis is what happens to renewables because of this. So Alphinity does have a sustainable fund, and we're doing a lot of work on this because it's probably supercharged the European move towards renewables, because they realize that the energy security and energy transition issues around Russia and being reliant on Russian oil and gas are more serious and certainly more timely than a lot of people were thinking. So our anticipation is that there's a lot faster and a lot more investment in European renewables, but that's certainly going to take time to transition that capacity. And then lastly, a big winner from this is probably the EVs or any, like a lot of those green sort of stocks. So we do have a position in Tesla, and this is an indirect beneficiary both because of higher oil prices and because it's seen as a renewable and an alternative to being dependent on oil and gas from different sources.
Okay. Interesting. Lots to think about it at a company level.
Yeah.
So I think one of the things you're saying is, high quality companies are always, the way to go within your portfolios and how you look at things. I think this slide talks a little bit about, how Alphinity invests, and is this something you'd like to take us through now, or is this the right time to sort of have a look at this one?
So I know the general rule of thumb is if you want to put people to sleep, then start talking about your process. So I will not spend too long on this slide at all. I've mentioned most of it before that we're looking for stocks that have earnings upgrade cycle that are high quality. I think that in this point of the market cycle, high quality stocks are absolutely essential. So Nike is a stock that we've bought recently, and it's one of the stocks that is in my coverage area. And I said, I don't know if 130 is the absolute bottom for Nike as a stock. It could go lower than that if the whole market goes down. But when I think of the franchise of Nike and the brand name of Nike and the growth that it has on a 10-year view, I'm happy to buy into such a quality business at this level. So those kind of, sort of enduring quality stories, I think are a good place to be in this kind of market. And then lastly is value. And maybe we can go to the next slide, which is about unprofitable tech, or how different parts. Yeah. So one of the areas that we don't invest in is unprofitable tech. And obviously when interest rates around the world are at zero and there's, discount rates are sort of impossible to determine, this sort of unprofitable tech and stocks that are meme stocks or are story stocks, they tend to do very well because people are focused on momentum and they're not focused on anything to do with valuation. And that's a part of the market that we generally, from a process perspective, we avoid because it's hard to get earnings upgrades when you don't have any earnings. But just thematically, I think that part of the market is very difficult because you've seen some stocks go down 30, 40, 50%. And because they're unprofitable, they still don't have a valuation floor. So it's sort of the opposite of Nike, where it gets to a certain level and you say, I'm comfortable with this valuation. I'm comfortable with this level, sort of no matter what happens with the market or macro or geopolitics. The unprofitable tech index is in the opposite category. It could go down another 20, 30%, and there's still no level where you can say, yep, I'm comfortable with that. So I think that whole unprofitable, low quality sort of meme stock area of the market is always an avoid for us. And I think specifically in this kind of market environment, it's an avoid.
That's particularly clear in talking about earlier that FANGs and related stocks, and even though some of them have got earnings, but they're getting hit harder. But stocks which is kind of riding on their coattails for a period of time are now being found out in that space.
Yes, exactly. So I think some of this we still love tech as a overall sector because there are those sort of structural growth and structural upgrade trends that don't seem to be slowing down. And the positive thing is a lot of these sort of mega cap tech companies, you're getting at very reasonable PEs right now. So Google is another one of my stocks. It's trading at 19 times 2023 PE, which if you think of, $1 trillion plus market cap, the level of growth, the brand name, the really interesting, innovative things they're doing, whether it's Google Cloud or Waymo or other bets, and to get all that for 19 times PE is pretty amazing. So there are some good value. Like it's very bifurcated, the technology sector. I think right now you have unprofitable tech, which is in a world of pain, and then you have some of the high quality mega cap tech, which are actually very good investments right now.
Very good. So we talked also a little bit about not getting into the detail in the process, but I guess part of what you think about are looking at companies which are long-term compounders, transformation stocks, or early stage growth companies. And the next few slides, I think we've got a few examples of those. So maybe you can talk us through how that fits into the process and Alphinity's philosophy.
Yeah, absolutely. So maybe I'll start with, you mentioned early stage growth companies. And as I alluded to a little bit in the unprofitable tech slide, early stage growth is not what we're about. That is a very, very different skill set than investing in high quality, long-term compounders or stocks that are in an earnings upgrade cycle. And it's an interesting thing because, I used to invest primarily in Asia and emerging markets. And at one point, about 12 to 18 months ago, there were so many unprofitable early stage growth companies that were listing in Asia and elsewhere in the market, and that were becoming very big parts of indices. So in Asia, you had stocks like Meituan and a lot of very unprofitable companies that were very big weights. And so I actually had sort of a teach-in with a friend of mine who works in VC, and I said, valuing unprofitable companies is not something that I do as a high quality. So can you tell me, how do you look at these things, and how are people looking at these things that they keep going up? And it was a very good session, but at the end, my main takeaway was the fact when these sort of unprofitable early stage growth companies are $100 billion plus market cap companies, and they are big weights in indices, is probably telling you that the market's run way too hard in this sort of thing, because they should not be able to reach this level of market cap and this level of influence in global indices when they haven't even made any money yet. So that part of the market, we're not in that. If you want to go into VC or something, that's probably more well suited than a global equities fund like Alphinity. But the other sort of categories that you mentioned in terms of long-term compounders, so Apple would be a good example. We did a lot of work in terms of Apple as an ecosystem stock. Like, is it just a handset company or is it an ecosystem stock? We are strongly of the view that Apple is an ecosystem stock. And you may even know this from your own personal use. I don't know whether you're an Android household or an Apple household, but certainly in our household during COVID, it went from me and my husband having an iPhone to everybody having an iPhone, everybody having an iPad. It's just like the proliferation of products. And now our whole household is in the Apple ecosystem, and nobody's leaving. And that sort of dynamic has been multiplied like literally billions of times around the world. Apple's installed base is now over 1 billion users. And so that's whole ecosystem aspect of Apple we find very attractive, because it allows them the pricing power and the brand power to be able to get in an earnings upgrade cycle and to be able to stay there. So, and Apple, not dissimilar to Google, it's not an expensive multiple given the quality of the company that you're getting. And Apple's balance sheet, I think, is something which is often overlooked because people just love the product so much. But, they have an ROE that's over 100%. It's like 140%. And so, that's almost unheard of. And the cash flow that they throw off and the ability for them to use that cash flow to do buybacks and continue to get that EPS growth and continue to drive the stock higher is almost unprecedented in global markets. There's a reason why it's such a massive company. So Apple is an example of a company that we certainly like right now. I think the next example
on that, Mary, do you think because Apple and Google and Amazon are such massive companies, there's sometimes talk about the political implications and forces that might come to bear on those types of issues. Do you think about that? Do you look at how that might play out in terms of government intervention or concerns around that side of it? We
do. So ESG is very important to Alphinity as a firm, and we have a very specific ESG integration process. So you can see on the right-hand side the material topics that we look at for Apple. And, we look at all ESG issues from a qualitative perspective. And then if you can quantify the impact of these issues or different ESG outcomes, then you need to do that in your model and reflect it in your valuation. And so for Apple, this is another one of my stocks. I looked at the different antitrust things, and particularly with App Store, and whether there's going to be fines on App Store, whether they're going to change the rules, around, paying different app providers. And in my worst case scenario, I was getting a 3 to 4% EPS hit. So, I mean, that's definitely manageable for a stock as big as Apple that has a lot of different levers to pull. So we do look at the governance issues, and they're certainly there, and we continue to track them closely, but they are not enough of an issue to not invest in these stocks. That makes sense, using multiple negatives. The other thing I'll highlight is that if any government in the world is thinking about cracking down on their tech sector, look no further than China for how badly that can turn out. So, these stocks like Tencent and Alibaba that used to be $500, $600 billion market cap companies, they're $200 billion market cap companies now. And they've been massive generators of both innovation and employment in China. And now both of those stocks are firing people. And, I've heard from on the ground that like that whole sort of push towards innovation, that push to be successful, and that push to have the next unicorn, that can now be seen as a bad thing because you may get targeted by the government. So I'm certainly not saying that America is looking at China and following what they're doing. But I think the whole situation in the Chinese tech sector has highlighted the fact that, these tech companies do a lot more than sell you iPhones. These tech companies, they are driving innovation at a very basic level, and they are huge. They're driving employment, and they're doing a lot of good things. And that cracking down on them for antitrust, may have unintended consequences that people haven't thought about.
Okay, great, thank you.
I think the next one is ASML, which is a. I won't spend too long on this because it's sort of in the same camp as Apple. So as many of you know, ASML is a semi-cap equipment company, so it makes the equipment that makes semiconductors, and it's in a long-term, sort of structural growth story and structural earnings upgrade cycle because it has such high moats. So it has huge amount of market share. For those of you that cover semiconductors quite closely, you'll know that during the Trump administration, Trump decided he didn't want to be reliant on Taiwan and TSMC for semiconductors, which, even though I don't really agree with anything that Trump did, that's probably not a bad analysis of risk return in terms of semiconductors globally. So there's a huge trend towards onshoring in the US. And now you're seeing an additional trend towards potentially onshoring in Europe, which is very, very good for a company like ASML. Because now it's not just saying we need X amount of machines, full stop. It's saying we need X amount in Asia, we need X amount in the US, we need X amount in Europe, and that's going to end up being way more, semi-cap equipment than there was before. So add on to that sort of technological sovereignty argument, the cyclical trends in terms of the chip shortage, and also secular trends in terms of AI and Internet of Things, 5G. You have a very good structural case for ASML. So that's a stock that's been in the portfolio for quite a while, and we continue to like it.
Right.
All right, so the next two examples are a little bit different. You asked me about sort of transformative companies, and I think Tesla is probably the best example of a company that's transforming an entire industry. So the auto industry was, to be frank, a bit boring for many years. And there was years and years went past, and I never invested in any auto companies at all. And then Tesla came along, and it really is hugely disruptive to the auto industry. And in our view, it's going to be a winner, not just in the auto industry, but because of the design of the business model. Not dissimilar to Apple, it's an ecosystem stock. And once you are in the Tesla ecosystem, you're not stuck there, but you want to be there. And again, not unlike Apple, the brand loyalty to Tesla is just absolutely amazing. So, the pushback that we often get on Tesla is about valuation. And yes, valuation is high because you have stocks like Mercedes, which I mentioned before, that are at 5 times PE, and you had, prior to the sell-off, Tesla was trading at 100 times PE. It's come down quite a bit since then. But, how can those two stocks that both make cars be valued in that, such a different way? So we use a sum of the parts analysis to value Tesla, because a lot of the value in the business is actually in the tech part, the full self-driving, or FSD. It's called for short. A lot of the value is in FSD, but Tesla, on a longer term view, I think is absolutely transforming and disrupting an old sleepy industry, and it's definitely going to be one of the winners there.
Great.
All right, and then lastly, sort of an example of a defensive is Pepsi. Everybody knows what Pepsi is, so I won't spend too long on that. But Pepsi, it's a company that's in an earnings upgrade cycle. They're doing a lot of things in terms of, product innovation. It has a little bit of a reopening play there. You asked before in terms of about reopening, and we're not betting the farm on reopening plays, but people going out more, people returning to restaurants, people consuming these sorts of products outside the home. There's a little bit of a reopening tailwind there, and the valuation was not expensive, certainly when we got into the stock, because these more defensive staples had been out of favor for so long, as people wanted to buy those high growthy, unprofitable tech sorts of companies. That our entry price and our entry valuation for Pepsi is very attractive. So that's an example of what I was saying before in terms of the diversification in the portfolio, to hold a transformative, relatively high PE stock like Tesla, a very solid high quality stocks like Apple and ASML, and then a defensive like Pepsi. That level of diversification is nice to have in a portfolio in this sort of volatile time.
Okay. That's great. I mean, I'm just looking at, down the right-hand side, the ESG comments, and the health and nutrition is one that kind of grabbed my attention when it comes to Pepsi, thinking about, soft drinks and chips and, all those sort of things, and how that fits in from an ESG viewpoint. So
if you had an extra 5 hours, we could stay and talk about this. Alphinity does have a sustainable fund, a global sustainable fund, and a domestic sustainable fund called the Sustainable Share Fund. And people think that, and we have an independent sustainability committee, which vets all the stocks that go into our investable universe and therefore into the portfolio. And people think, oh, you would spend the most amount of time debating fossil fuels or technology or something like that. The most, and it's not even, maybe controversial area is health and nutrition. Because for those of you that know about the Sustainable Development Goals, which is how we define sustainability, you have SDG 2, which is about no hunger and access to food, and you have SDG 3, which is about health and well-being. And for a lot of these staples companies, you have, 2, they are providing food, but the food is not nutritious. And so for us, quantitatively and mathematically, how do you balance those things out are very important. So generally what we do is align companies that sell food to SDG 2, because they are, if you're hungry and you eat a bag of chips, you won't be hungry afterwards. But then we take off that benefit from SDG 3 if that food is unhealthy. So I guess the interesting, we do a lot of company engagement for all the companies. And when we talk to food companies in general, they are all hyper aware about the focus on health and nutrition, like absolutely hyper aware. So McDonald's is a stock that we own in the core portfolio. And I mean, yeah, they are really aware that if they don't make improvements on health and nutrition, that they're going to lose market share to companies that do. So it's a big area of focus, and it's something that we look at both quantitatively and then also qualitatively in terms of what companies are doing.
Yeah, fantastic. No, it's a fascinating area, so we maybe have to pick that up next time.
Yeah.
So we're coming up on 1:15, so I think you've touched on a little bit of that, but open it up for any questions. I've had a couple of comments from people that they're Apple users when we're talking about Apple, so that
oh, great.
not surprising to see that featuring in the portfolio. But if there's any questions out there, now's the time to fire away before we wrap it up. So while we're waiting for people to get typing, Mary, is there anything you wanted to finish on?
No, thank you very much for the opportunity to speak today. And yeah, the only slides we didn't get to were the one with the top 10 and the pie charts, but those just highlight what I was mentioning before in terms of having a high quality, diversified portfolio, diversified across geographies, across sectors, and sticking with really high quality companies that you can trust through thick and thin. That's how we're positioned right now.
Yeah, and it feels like in a time of great uncertainty and lots of upheaval, having that confidence in trusted names is a very positive attribute.
Yeah, absolutely. It's a good place to be.
Yeah. Okay. Well, I think you've obviously answered all the questions everybody had before they came along. So nothing else coming through. But thank you very much for your time, and thank you for the work that you and your team put into preparing the presentation, and for the work you're doing in looking after portfolios for our clients. Actually, here we go. We've got one question just in the nick of time. The question is, what's the position on Nestle and Russia?
So Nestle has, again, like many other multinationals, it has relatively small exposure. And I think what Nestle and some of the other more staples related companies have done is they have stopped selling more discretionary items, and they have continued to sell what they call, like core, not core, but sorry, I can't remember the term. It's like necessary items, which we think is fair, because you don't really want to punish Russian people for what Putin may be doing. So companies that have a well thought out approach to that, like Nestle and some of their peers, is we are certainly comfortable with that. I think so for Nestle and Pepsi and some of these other companies, McDonald's, we're certainly watching the duration of the conflict and what that's going to mean. And then Nestle, just as an overall comment, it is a stock that we own and a stock that we really like. From an ESG perspective, they've done a lot of work in terms of looking at their supply chain for cocoa and coffee and for a number of the other things. And we've seen a lot of improvement there, and certainly a lot of thought leadership from them in the consumer staples sector. So the Russia exposure is not a reason not to own them, as I mentioned before, and we're watching how that situation continues to play out.
Fantastic. All right, that's great. Great to have got that last question in there. But once again, thank you very much for your time, Mary, and for everybody at home, thank you very much for tuning in and your attention. You'll receive a copy of the slides and a recording of the presentation over the next couple of weeks, and it'll be up on our website shortly. So if you have a chance to review that and you have any questions following that, please get in touch with your advisor or send me a note, and I'll get it through to Mary. But thank you very much, and enjoy the rest of your day. And thank you, Mary.
Great. Thanks so much.
Bye.
Bye-bye.